Morning, everyone. We're just going to wait 30 seconds or so just to allow those that haven't to enter the seminar. 30 seconds always seems like a long time when no one's saying anything. So that feels like 30 seconds to me. So hello, everyone. For those that don't know me, I'm Lucky from the Numis Investment Company's sales team. Thanks for joining us for what is our fifth in a series of ESG seminars. This one we're calling Tipping Points. I'm not going to give too much of an intro today because I'm just really excited to hear what our guests have to say. During this series, we've heard from the investment trust sector on what investors want from their investments in terms of ESG disclosures and best practices. We've heard from investment managers about how they integrate ESG into their processes. We've looked at private versus public capital through the investment company framework. But what I think might happen from today's session is we put another piece in the puzzle. We have some time at the end, hopefully, for questions. So please use the anonymous Q&A at the bottom of the screen, which you'll be familiar with, and our endeavour to put some of these to the guests at the end. So I'm delighted to be joined by three very distinguished and prominent experts in their field. And if I might use a broad term of sustainability, Alice Chappell, founder director of Impact Value, an advisor on impact investment and sustainable finance, and an independent director of Schroders Big Society Capital Social Impact Trust. I'm joined by Chris Dodwell, who is head of policy and advocacy at Impacts Asset Management. He's a climate change and environmental policy expert with over a decade at the heart of the UK government's work on climate change. He led the UK's implementation on the EU ETS, which we'll hear more about, and head of the UK delegation to the United Nations Framework Convention on Climate Change. And Professor Tim Lanton, Chair in Climate Change and Earth System Science and a Director of Global Systems Institute at the University of Exeter. Tim studied with James Lovelock and is author of the book Revolutions That Made the Earth. This is a good book, Tim. And he's known for his work on climate tipping points. So Alice, if I could come to you first, and just if you could introduce yourself a little bit so we can learn a little bit more about your background, your business, how you're thinking about the subject, perhaps from a high level, before I sort of drill down into some questions, please.
Thanks very much, Lucky. Yes, so as Lucky's mentioned, I run a business called Impact Value, which advises funds, financial institutions, companies, NGOs on driving impact, really, but within a financial framework. So the returns that they need to get are a big factor in what impact people are looking for as well. I run a course for Cambridge on sustainable finance, so have had the privilege of having about 1,000 students through that so far, who are giving me as much learning as I'm taking from them, I think, in terms of what works and doesn't work in the sector. As Lucky also mentioned, I'm an independent director of an impact trust, an investment trust called Schroders BSC Social Impact Trust, which has a deeply impactful approach to its investments and combines impact with a trust that can be bought and sold, obviously, and therefore can be very much part of a pension fund portfolio. And I think that's the way forward. My final remark is simply that I think the emphasis of all of my career has been on trying to drive capital towards the places that need it. And the tipping points that we're going to be talking about in this session are so crucial in terms of driving capital as far and as fast with scale and urgency. And we need different kinds of vehicle, not just the plain ESG, to do that.
Thanks very much, Alice. And Chris, could I come to you now, and the same sort of thing, if you would, for the benefit of the audience, just introduce yourself and your role.
Yeah, thanks, Lucky. So my name is Chris Dodwell. I'm, as Lucky said, I'm now head of policy and advocacy at Impacts Asset Management. But I've basically worked in this sector for about 25 years. I first came into the area through a legal background. Back in the 90s, I was working kind of defending polluters, and then I went to work on the side of the angels, as I saw it, going in and working for the UK government. So I was fortunate enough to work there from 2000 to 2011, which saw a tremendous kind of surge of interest in climate change, a whole load of policies coming through, including first efforts at carbon pricing, and then naturally kind of got excited by the idea of global change in relation to climate. So got to work on the UN negotiations, and then spent about 8 years out in consultancy. And one of the things I guess I really had begun to appreciate is that we weren't going to get anywhere in solving climate change unless we mobilized private investment, and that I didn't really understand how that market worked. So I joined Impacts 18 months ago, and was fortunate enough to kind of land in a company that kind of really believes in both the opportunities that the sector kind of has in terms of market disruption and kind of growth, but also in the role of policy in kind of changing the marketplace and creating those markets. So my role is really twofold. Firstly, I keep the investment teams updated on developments in policy so that they can identify where growth opportunities lie. So one of the things we've been doing is almost on a sector by sector basis, going through the idea of net zero and the transition to net zero, and thinking about the new technologies that are going to be required to kind of rewire the economy, shipping, steel, all of these sectors that are going to have to be sort of transformed, but also simple things like building efficiency, and a huge growth in those sectors. But I also take part and lead our policy advocacy work. And that's really focused on three areas actually. So the first one is, how do you have the policies in the real economy that will mobilize and drive the investments that we need? And I'll talk a bit more in a moment about how one engages on that. Secondly, the kind of the revolution that's going on in terms of financial services regulation, greening the financial system. How do you make sure that the policies there are useful, decision useful, avoid being some kind of manifesto for red tape and reporting of spurious information that isn't actually going to make a change. And lastly, looking for the new trends. And one of the things we've really been tracking over the last year has been the rise of interest in nature-related, biodiversity-related investments. So I'll hopefully get a chance to talk about that a little bit later on, but great to be here, and thanks for the invitation.
Thanks, Chris, and yes, we will get onto that subject. And Tim, can I come to you now, and just for the benefit of the audience, if you could just give me a little bit of background about you, please.
Yeah, sure, Lucky. Thanks for inviting me. Hi, everybody. My name's Tim Lanton. I'm a climate scientist, or we call it Earth system scientist. As Lucky mentioned, I got kind of, as an undergraduate, captivated by Lovelock's work on what he called the Gaia hypothesis, studying the Earth as a living complex system, and determined that I wanted to research that. And that was when I was a 18-year-old kid back in the early 1990s. And so since then, I've trained in thinking about the Earth and the people within it as one coupled, complicated, or complex system. And by the early 2000s, I was kind of a little concerned that we were just telling ourselves these linear stories of climate change. It was all going to unfold smoothly. It might be a bit unpleasant, whereas Earth's history was telling us that the planet can be a volatile creature, and it sometimes jumps around. So I determined then to work on climate tipping points, or to put together what we know about the risks we're running of triggering abrupt and or irreversible changes in the climate. We didn't publish that till the late 2000s, but it's been a quest since then to keep kind of waving the red flag about this major risk that we're running with climate change. But all the while, I was also motivated to think about how can we apply the same kind of thinking to get us out of the massive hole we've dug for ourselves. So how could we use like an understanding of the complex systems of society, the economy, including finance, to think about how, for sure, in the past, human societies have changed abruptly. They've changed their technologies abruptly. How could we engender that to happen again now, to get us on the path to radically accelerate decarbonisation to, essentially reach what's now being called net zero quickly, but do so in order to avoid the big risks we're running with the climate tipping points. So yeah, the connection there is really, it's exactly the same kind of thinking that helps us identify the biggest risks, but also helps us identify these kind of nonlinear opportunities to get out of trouble. And in that vein, as someone who does the kind of techie science side of that, we worked for over a decade on the fact that there are sort of very general early warning signals of tipping points before they happen in different complex systems. So that can help us warn of the bad ones that might be coming in the climate, but we might also use those to sense, okay, which markets, which bits of the social system, the economy might be most amenable to being tipped in a desirable direction. And that's something I'm working on now. You're on mute, Captain.
I knew that would happen. Always does. Thank you, Tim. So Tim, I was just saying, let's stick with that theme. And most of us by now would have heard this term, climate tipping points. And like you say, like I've said, you're known for your work on this space. But it's possible not everyone in this audience has. So I just wondered if you could just drill down a little bit on that, and why they are important.
Sure. So we use this word tipping point to refer very generally to where a small change makes a big difference in the outcome for some system. And in this case, with the climate tipping points, the system's, of course, the climate. And we could mean that at one level, the whole climate. I mean, the biggest risk we run is could a little bit of extra global warming basically trigger self-reinforcing change in the whole climate, so that we start to kind of lose control of the climate because carbon release, say from thawing permafrost and so on, is adding to warming, and we're having trouble, stopping a change that's underway. That would be a huge risk. But also, when I started thinking about climate tipping points, it was clear that there are bits of the climate system like ice sheets or the circulation of the Atlantic Ocean or big monsoon systems that have tipping points within them, if you like. So at some level of warming, we could trigger the irreversible loss of the West Antarctic ice sheet. That gives us 3.5 meters sea level rise eventually, or do the same thing for Greenland, 7 meters of sea level rise, or tip the dieback of the Amazon rainforest, or tip the major disruption of the monsoons in West Africa or India. Those things are bad enough in terms of impact to want to get some handle on how likely are they, how quickly or slowly would they unfold, are they truly irreversible, what can we do to avoid them. And so the work on tipping points is about putting those bits of the climate system that might have a tipping point on a map, and we've got about 10 candidates for that, and really getting to the bottom of where are those tipping points and what are the consequences. And if there's one little saving grace in this, it's important to realize that different bits of the climate change at different rates. So not everything that passes a tipping point then immediately goes to some other state. Some bits of the climate move really quickly, like the atmosphere. So if you tip a monsoon, really it changes quickly. But other bits of the climate, like glaciers and ice sheets, move slowly, if you like. So we might commit, them to change by passing a tipping point, but that change can still take centuries to unfold, and we might still be able to control to some degree something that we can't avoid, which is how quickly the ice melts and the sea level rises.
Thanks, Tim. It's quite a bit stark.
That's why I work on the positive tipping points as well, Lucky, because if you spend your whole time leveling with the reality as a scientist, it's hard to get out of bed some mornings.
I bet. So, and Alice, if I could come to you now, and I mean, how do you think about this in the sort of social dimension, and how does that play alongside these environmental challenges we're facing?
I think there are at least a couple of ways of thinking about the social dimension. I mean, one is that this is all caused by social factors, that we have created climate change through social, through the way we've organized our society. So we have to resolve it through social factors as well. I mean, that's the fundamental point. I think what's very interesting in the stage we're at the moment, and Tim's analysis of the tipping points and others shows that within the next 10 years, really, we have to have made a significant shift towards, for example, halving global emissions by 2030, if we're going to have any chance of reaching the 2050 goals of 1.5 degrees temperature increase before over pre-industrial levels. So given that scale of shift, we know that the social change that has to happen is significant in terms of the way that consumers behave, and particularly in the way that investors behave. I think so that's the first point. I think the second really interesting point is that there's quite a few people I speak to, and I'm sure Tim and Chris are the same, who say this environmental imperative is so great that I'm sorry, we're just going to have to ignore the social imperatives. We're going to have to plant forests in places where maybe communities have land rights, or we'll have to put renewable energy everywhere, never mind the fact that that will stem growth in some countries because it's not as affordable perhaps on the margin at the moment, although that's changing significantly. My argument actually is that you're never going to get people buying into these environmental changes unless you've understood and respected the way that it might affect them. So we've seen Trump coming into power, we've seen Bolsonaro coming into power in Brazil, we've seen political grassroots who are resistant to environmental change because people don't think that their social rights have been respected. So there are very complex interactions, but I think those are some of the things we really have to tease out if we're going to get somewhere. And the tipping points that we need to see are things like the amazing change that's happened, I think, in social tipping points over the last couple of years, where social tipping points like regulation, social tipping points like politicians having it at the top of their list of things to talk to the electorate about, social tipping points around what investors can actually do and the power they can have to allocate capital in the right direction. So some really interesting social dimensions that we can come back to.
Thank you, Alice. And Chris, if I could come to you now, unless anyone has anything they want to add on that. As I said, and you've mentioned, you're at the heart of the UK government's response to climate change for over a decade. But what I'm really interested to know is, can you explain to us, like in layperson's terms, how engagement with government sort of works in practice?
Yeah, sure. I mean, firstly, I'd just like to say that I completely endorse what Alice was saying around social acceptability and the fact that one has to come up with policies that are going to actually be built on what people want to happen. And you won't get that if you are not thinking about how individual lives are going to be affected by the transition. So I kind of think this concept of a just transition is actually a really important way to kind of think about this, but also we need to think about all sorts of dimensions of what's going to happen as we develop these policies. And I guess that's partly why, thinking back to my time as a policymaker, why you needed to get engagement with stakeholders from a really broad range in order to make things happen. When I worked at DEFRA, we had, this was under David Miliband, who loved, rules of three, and we had a really punchy three-phrase kind of mission, or the way that we were approaching our mission, which was aim high, reach out, pull together. And so we stuck with me, aiming in terms of the ambition, pulling together as a kind of a team, but reaching out. And whenever you had the moment of pause, when we were introducing, say, something like the carbon trading, the reach out would kind of come back to you, and it would be, well, are you talking to all the right stakeholders? Are you getting the wisdom of all of the right people into your process? So if I flip that now into the world that I work in as in the asset management business, the first question is kind of, well, why has Impact's got a policy advocacy kind of expert, and why would you want to be doing that work? And I guess it's kind of a simple matter of enlightened self-interest. So, we are a business that is wholly founded on opportunities arising from a transition to a sustainable economy. We do that in order to generate outperformance for our investors, and therefore what we want are markets that effectively address environmental challenges in a smart way. And actually that's what policymakers want as well. if you look at the way the kind of the capital that needs to be mobilized, I'll come back to the Committee on Climate Change a little later on, but basically what we need to do is we need to change the investment capital going into low carbon technologies from around 5 billion a year now to 50 billion within a decade. This is one of those tipping points I think that Tim's talking about in terms of positive flips. And then we've got to sustain that 50 billion a year all the way out to 2050. So it's a classic kind of S-curve. So policymakers actually want to understand, how do you mobilize that private capital? How do you create opportunities that are de-risked? And there's a real sort of win-win solution there. So that's why you do it. The other thing that it gives us as an investor is more confidence in what technologies are likely to be deployed. So what's the transition going to look like? If you are on the same page as the policymakers, you know you're all moving in the same direction, but also you can understand where things are changing and how that happens. So how we do that is we do it through membership organisations. So we're members of things like the IIGCC, UK Sustainable Investment, PRI. We are members also of a lot of issue-specific organisations. So we're members of the Energy Transitions Commission, which is a sort of multi-sector task force that's chaired by Adair Turner, that is wholly committed to kind of transition across scaling up investment in clean electricity, but also hard to abate sectors. So that brings us into a really nice group of people who are also pushing for the same thing. But also we're doing some quite innovative work through things like the Coalition for Climate Resilient Investment, that's trying to think about how you bring physical climate risks earlier into infrastructure planning, so that you build them into the design of your investments at an early stage, rather than having to bolt it on later, having higher OPEX. So you get the kind of the capital distribution right by looking at cash flow analysis. And then lastly, we do some bilateral engagement. So we have been fortunate enough, Impacts has been in this area for 20 years. So we've had quite a lot of experience of working on stuff. So we've spoken to the UK Treasury around the development of the UK taxonomy. We've had calls and meetings with the Committee on Climate Change about their work. And we sit on a number of government groups that are steering groups for kind of initiatives that are around this issue of mobilization of finance, and how do you get finance into new technologies. And I think all of that is really legitimate. You know, this is not kind of behind the door, you know, behind the scenes lobbying. This is bringing together all of the talents and all of the knowledge and all the experience out there in order to try to solve what is, you know, the biggest challenge that we have of our time, and is going to lead to a change in all our lives. So I think improving that dialogue and having genuine understanding of the positions of the different key players around the table, and that means you've got to build capacity on both sides. You've got to build capacity in investors around how government decision making works, but also you really need to build capacity within governments. And I feel this very personally, because I did it when I was there as a policy maker, is how investment decisions are made. And what's key there is the role of risk, and how risk affects investment attitude, and how one can adjust your policies in order to de-risk investments in particular sectors. And I'll come back and talk about a specific example of that later. But I think this understanding of the economics of the sector and the economics of investment is something that policymakers don't naturally appreciate.
Thanks, Chris. It's encouraging to hear the legitimacy of it, actually, from someone that's been through it. Tim, if I can come back to you, and Chris had mentioned this roadmap to net zero by 2050. It's a topical talking point, particularly in business. But as a scientist, though, is this a realistic goal, or is this another case of like kicking the can further down the road? And can you give us a sense of, it's a bit multi-layer, but can you give us a sense of what needs to be done, the size of the task, in order to make this sort of transition happen successfully, please?
Sure, lots buried in those questions, Lucky. I mean, I think the first thing I want to say is we can use the language of transition if we want, but really this is transformation. So when I talk about the idea that we need to have like positive tipping points in society, when I use language like tipping points, people like me are saying, look, there are these societies, a complex system. it has these alternative, we would call them stable states. If I was with you in a room, like chatting about this stuff, I'd say to you, look, sitting upright on a chair is a stable state, lying on your back, sprawled on the floor for the chair is a different stable state for the chair. If you lean back, you get to a balance point where a nudge one way or the other is going to send you to one stable state or the other, in a dramatic fashion, potentially. So when we talk about a stable state in like the whole economy, well, there's one where it's powered by fossil fuels, and there's one where it's everything we do is powered by renewable energy, maybe with some backstop nuclear, lots of storage of battery and other forms. But those are radically different states in the sense that, as I think we all know, there's plenty of subsidy and market distortions that maintain an incumbent backstop energy, as we call it, has been fossil fuels. And there's a whole, you can imagine an alternative stable state for energy powering the whole economy that of course has its own, what we call negative feedbacks, but policy support, market distortions or whatever to maintain it as a stable thing. This is the nature of our social and economic and complex system reality, but we're talking about making the transformation from one stable state to another here, and doing it within a generation, if not quicker. And to do that, when people like me talk about this, we kind of cartoon the system as like two valleys with a hill between them, the two stable states with a hill between them. We're trying to essentially lower the height of the hill or push the change of the system from one valley to the other. What does that mean in real terms? Well, it means for a systems thinker, we can try to find ways to weaken what are the damping feedbacks that maintain the incumbent state that we want to get away from, and/or we can try to find ways to strengthen what we call the reinforcing feedbacks that propel change from one state to another. I put more emphasis on the latter, and that's where I start to use the language of positive tipping points, because if we can get reinforcing feedbacks going strong enough, they become self-propelling and they accelerate change. So to come back to the net zero question and the real numbers, right now we're decarbonising the global economy at about a fifth of the rate it needs to be decarbonised to avoid these catastrophic climate risks. So we've got to accelerate things by at least a factor of 5. That means we absolutely have to find some of these reinforcing feedbacks that when you get them going, propel that acceleration. So what do I mean by that? Well, I mean like things like what we'd call economies of scale. So the more batteries that get made to go in electric vehicles, the cheaper the next battery becomes. And that one is on a spectacular economy of scale at the moment. But so too are solar PV panels, as I think, and offshore wind power, as I'm sure you should all well know. That's one of many, many reinforcing feedbacks that we can think about in this context, including much more social ones, like scientists talk about social contagion. We do have a habit of copying what our neighbours are doing, and we do see social contagion in the uptake of solar panels on people's roofs and now in the uptake of electric vehicles. Well, I'll pull back from the detail, but essentially it's finding and triggering those reinforcing feedbacks and getting them strong enough that can cause the acceleration that we need. How much do we need, Lucky? Well, 2050 global net zero greenhouse gas emissions gives us, maybe even odds, I would say, of staying, getting around 1.5 degrees C of warming or well below 2 degrees of warming. I don't think it gives us what I'd call Russian roulette odds. And if the risks are really high, I think most of us would rather have a Russian roulette odds. There's one bullet in the canister of 6 holes, so we've got like 1/6 chance that things are going to go badly wrong, but 5/6 chance that we're going to save ourselves. So that's why you will hear, quite rightly, many groups pushing that maybe 2050 might not turn out to be the right number. The other crucial thing in this language of net zero that we need to talk about, though, is it is a bit of kicking the can down the road when it refers to this dream that we're going to be able to do massive carbon dioxide removal from the atmosphere in the latter half of this century, basically most of the scenarios you'll see or hear about to limit warming to well below 2 degrees C are banking, shall we say, on there being this deployable in a social, ecological and technical sense technology on an enormous scale by some future generation who are presumed to be spectacularly richer than we are and smart enough to have worked out how to do it while still feeding their population of 10 billion or whatever. And speaking frankly as a scientist, we can't bank on that. We've done the calculations, the scale of global carbon dioxide removal that's being banked on in many of these scenarios, which involves biomass energy crops, fancy power stations that convert them to energy but capture the carbon. There just isn't the land available realistically to believe that that is going to happen. And the other technologies that suck the CO2 out of the air with physics and chemistry are spectacularly expensive because they're trying to beat what's called the second law of thermodynamics. So they'll always be expensive. So my message there is really, we've used, in my view, the wrong economic paradigm to, as usual, that naturally opts for these later options when we're all assumed to be spectacularly richer and we've discounted the future as an excuse to not act more decisively now. And the simple message is that isn't a viable option. We have to accelerate the change we need right now on the things we know how to do right now, and there are plenty of them.
Thanks, Tim. There's a lot to think about there. And Alice, if I can come back to you now, just thinking more about the social side. You know, the financial sector can and should it use its capital more wisely to drive positive impact? You know, I speak to many clients, and they often say they're worried about their fiduciary duty in terms of making a return and whether that's too philanthropic.
Yeah.
That's so. I guess maybe I'm a bit leading this, but in the sort of framework of maybe Schroeder's big society.
Yeah. Well, I think what you just heard from Tim is that it would be the people's fiduciary duty in trying to stop this happening, this climate change happening, is a much bigger fiduciary duty in my head than sort of sticking to the sort of same old paradigms of where returns need to be generated. So I think what you've got is at the moment, and great to see some money flowing into ESG, for example, which is safeguards at least, and that's good. But you've also then got in the next sort of layer, you've got people pursuing net zero, and that's also good. But as Tim said, that's sort of, I'm afraid, not really enough if it's relying on those emissions or relying on people putting things further down the road. So to me, the fiduciary duty that people have, as people on your call who are investors, are going to have to think about their fiduciary much more widely around how can we design structures that can drive capital in ways that is not the traditional ways. You've got listed equities and you're picking and choosing which ones you tilt towards. That's not going to solve the problem in nearly as fast and as urgently as we need and at the scale we need. So how do we design structures that can drive that deep impact on climate but on other things? And that's where the Schroeder's this Schroeder's BSC Social Impact Trust is a really good example of something which is packaging up very impactful projects, and in fact, in that case, it's trying to address social challenges in the UK, entrenched social challenges in the UK, packaged up into an investment trust with some illiquid assets, including what are called social outcomes contracts, which are agreements with government. They used to be called social impact bonds, but agreements with government to deliver on public goods, which I think we need some of as well. Those kinds of innovative structures, which can be put into portfolios in line with fiduciary duty, because not only are they trying to prevent these awful things happening down the line, but actually even in the short term, they have diversification benefits, they have inflation protected benefits and so on. So there are very clear reasons why fiduciary duty and impact investment of various kinds are aligned. And I think people have to get away from a sense that there are trade-offs, because actually you look beyond even the next 5 years, and it's quite clear that that if we're not investing in these kind of assets which drive capital in a completely different direction, we are going to be not doing our clients any service at all. So I think that in my head is such an important clear need for those innovative financial structures, of which investment trusts are clearly one that can fulfill that function. They can have illiquid assets wrapped up in an instrument that people can use in their portfolios.
Thanks very much, Alice. And Chris, if I could come to you just on as you've already said, you guys at Impax Asset Management, you've been investing responsibly for more than 2 decades, and as a salesman working in an investment bank, the ESG marketing trend, I appreciate it's a mega trend, but are you concerned that there's important messages are getting diluted because of this thing that we're all on at the moment?
Well, I mean, first off, sitting where I am, I couldn't say that the trend of investing into ESG is something that we see as a bad thing. I mean, we've reached the point where we've scaled up massively over the last couple of years. Since I joined, we've actually doubled the number of assets we have under management, and we're now heading to something close to $50 billion US dollars. So you can see there the scale of the demand coming from the sector. So I think that is not a bad thing. I do think that I think you're absolutely right though, that the important messages are being diluted, and that there is a risk of fiddling by while Rome burns a little bit. So what I'm nervous of is that we focus our attention on well-intentioned, but ultimately issues that may not take us as far and as fast as we need to go. And that's why at Impax, what we've really focused on are the real economy policies. And I think that would be my main message. Yes, we need to then think around what we have to do consequentially around regulation of financial services. But I don't think, I would say, and there are some advantages in some innovations like this sort of trend to net zero targets, but I think it's overplayed, to be honest. I think that there is a risk that we kind of view those targets and measuring them as somehow some kind of surrogate for having the clarity of direction from policymakers around how we're going to get there. And I'll give you some examples of that. So if you think about, as I was taking us back to the Committee on Climate Change's work, I think the UK is in a wonderful position to try to get moving thanks to the work of those guys. We've got clear roadmaps for all sectors around the technologies. They're not predictions, you can't be absolutely certain, but they show you what a world that could transition us to get us to the 80% reduction by 2035 that's called for to get us to net zero. They identify sector by sector the technologies that need to be scaled up, and they identify the financial flows that are going to be needed. And what we need to do now is roll up our sleeves and think about how to mobilize that finance and how you can actually achieve the transformation that Tim's talking about and the tipping points. So we've done that once before. Back when I was in government, the electricity market reform got launched. It was all around how do we mobilize investment. A lot of it was around how do we mobilize investment into offshore wind. The government set up the low carbon finance group that it worked with in order to design the suite of policies that share the risks for that investment, including the risks around getting the energy once it was kind of off the sea and into the grid, which government picked up. Setting up the one-stop shop through the Crown Estate around doing the licensing. Again, that helped investors because it was a simple framework to work with, and coming up with a really innovative way of doing the contracts for difference that has kept competition in it. So you're now no longer subsidizing wind Wind power, you're actually just providing a price guarantee should the market price drop. And all of that has crowded in the investors. And we've seen this transformation happening there. We've just got to repeat that exercise again and again and again across these other sectors. It's not going to be straightforward, but actually the model is there. And that's how we'll achieve the investment tipping points. And just to give you a couple of examples of what I mean by that, the Energy Transitions Commission has created its model of how you get to net zero that tries to rely as little as possible on the sort of pie in the sky, we'll invent them in the future type technologies. But if you just think about two technologies that are key to that, the first one is electrification of as much as we can, and making sure that all of that electricity is clean. Now that is going to lead to an increase in electricity demand of about 2 to 3 times in developed countries, about 5 times in large developing countries, emerging economies like China, and around 10 times in lower income developing countries. That is a massive transformation. Can we do it? It will cost about 2 trillion a year in investment. We're currently investing 1 trillion a year in fossil fuels. So yes, the capital's available, but we now need to work out how to redirect it. And there's other stuff in that in terms of investing in electricity systems. So once you've got something that's wholly reliant on intermittent renewables, you need to have other ways to balance power within the grid. You need to upgrade the grids. So there's a whole investment opportunity there. And there's a similar story around hydrogen. The issue with hydrogen is that we neither have clean source of production at scale, nor clean end use cases at scale. So we've got to do both of those things together in order to drive down the costs of that. And that is why we need smart policies that can encourage anticipatory investment, where you're only going to get the payback a little bit further down the line. And that's going to use venture capital, various different types of public-private partnerships. But I hope you can see there, Lucky, that that for me is where we should be focusing our attention, is on those things. Yes, we do need to ensure that we don't have greenwashing. So things like the EU taxonomy is important, but it's not half as important. It's not a fraction of as important as getting that investment mobilized into the sectors. So that's what I think the potential distraction is that we lull ourselves into a false sense of security that somehow corporate net zero targets aimed at 2050 transitions are the answer to the whole thing. They'll help drive change, they'll help create political space, but we've got to solve this sector by sector.
Thanks, Chris. And perhaps Tim, if I could come back to you, I mean, because people who are vocal on the subject of climate change say we need to listen to the science. As a scientist, and perhaps listen to what Chris has had to say there, what role do you think the financial services could and should be playing in this?
Good question, Lucky, because I'm a scientist and not an expert in financial services, so I would hesitate to give the sort of granular steers that Alice and Chris can do, but I have hopefully got the kind of systems view on this. So I would say a few things. I mean, at a very basic level, to an ordinary citizen like me, the fact that the financial services sector manages something like, $100 trillion of capital is way more than enough than you would need to tip the change we need. So in a simple sense of power, by moving that capital around, you easily have as a sector the power to help all of us solve this existential risk problem. Now, it's a different question to say, well, by what mechanisms and what processes do we need to change to see that redirection of capital affect the change that we might all morally agree we want to happen. But at the basic level, you've got an enormous potential contribution to make here. But of course, as Chris and Alice are alluding to, this transformative change is kind of cutting across different, should we call them sectors of the economy or society. And we've already been hinting at how we need different people in different sectors to be coming together on this. So we've heard about, policy and governance needing to align with the financial sector. well, also I think with those industries that are making the new transformative technologies, etc., etc. And at that point, many people would throw their hands up in horror, I suppose, and say, you know, we don't talk to those people enough, or we don't trust them, or it's just too complicated. But somehow we've got to grow up and kind of get around tables together and see that we've got aligned interests here. And I think the conversation already shows that we all have. So we should be able to crack this difficult nut of knowing that we've all got a common goal. And if we work effectively with the right timing and staging, we can make those positive tipping points happen more easily than if we're still pushing it against each other or poorly aligned. And as Chris has alluded to, the UK is actually a pretty good microcosm to be finding that alignment and trying to make the change happen. So yeah, there's obviously the capital element. I'm well aware that also as a sector, you're effectively advising many of those you're investing for or investing in. And I think that advice role is really, really valuable, because it's all part of that joining up so we all realize, oh, we're on the same page with this. We all kind of want the same thing as human beings, which is we don't want our kids and our grandkids to inherit the climate catastrophe, or indeed ourselves in later life. And what to say beyond that? Well, I would say recent history shows us that you know, finance has played a pretty critical role in some of the what I'd call positive tipping points that are already unfolding. So the case of solar photovoltaic panels, why are they now so cheap and exploding? Well, the backstory from the experts in the field, is that there was a critical moment at which someone moved from the key research group in Australia to China, and then 5 different startup companies in China floated on the US stock exchange in about 2007. Good thing they floated then and not, you know, a year later when the crash was happening. But by serendipity, the fact that the investment went in, albeit that there was a bubble in that sector and blah, 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 that pulse of investment was, according to all the experts in that field, was absolutely crucial to what we see now, which is that the economies of scale have triumphed, and solar is already, you know, spectacularly out competing, together with battery storage, etc., other options, and like offshore wind, is destined to keep on getting cheaper and cheaper. So that's a good news story. But as Chris is alluding, you know, we know where some of the things we need to shift capital and investment into are. I suspect you all hear about, I expect you have a hydrogen power seminar or whatever talk to go to every week. But my message would be, think even more broadly, think laterally, think, hold on a minute, this is transformation of everything. So food and land systems, they're going to change completely. Alternative proteins, plant-based meat substitutes, synthetic meat, this is going to explode if it hasn't exploded yet. Are you already looking there? If you're not, I'd be surprised, because I'd expect, you know, investors in the investment and the financial sector to be a bit more on it than I am about where the opportunities are, because the core message is we're seeing these self-reinforcing, self-accelerating feedbacks starting to kick in for some of these technologies. They're destined to kick in for others. And when they kick in, as you well know, there's a whole lot of money to be made, as well as a whole lot of good to be done. So let's work together to find and trigger those opportunities, of course, is the simple message.
Thanks, Tim. That's quite inspiring, and obviously you've got a lot of work to do on that front. I don't know if anyone else has got anything they want to add to that. If not, then Alice, I just wanted to ask you, you know, to what extent are we? This is a subject I always like to bring up, but to what extent are we seeing biodiversity cross into the social factors? And the reason I ask that is a lot of the teaching within ESG, it tends to bucket the biodiversity story within the environmental facet. But I just wonder what your thoughts were on that.
Yeah, I mean, and it tends actually, a lot of the E is focused on climate change as well, and not yet biodiversity, although we're getting to the biodiversity loss piece quite quickly, and hopefully TNFD, which I think Chris might be mentioning about later, but TNFD, the Task Force for Climate for Nature-related Financial Disclosures, will follow the pattern of TCFD, and we may get there more quickly with TNFD. I think, as with the comments that I made on climate change, I think we do have to be very clear that biodiversity changes in biodiversity do affect, particularly where there's both our impact on biodiversity, which is obviously affecting the rapid loss in biodiversity, 60% since 1970. I mean, the numbers are appalling, but it's also our dependency on the biodiversity as people that is so crucial. And the Descriptor review highlighted that so clearly, where, you know, we depend on biodiversity, you know, for obvious things like the rainfall on our agricultural land, for, you know, fish stocks, but all sorts of things that we're dependent on. So both our impact on biodiversity, which clearly we should mind about, but also the effect of biodiversity loss on every business. I mean, Tim was alluding to a lot of it there, but every business that we are invested in has a biodiversity component which will be affected as we lose biodiversity. So I think that in talking about the tipping points again, I think the alertness of individuals to that change that biodiversity loss will create around ways they can consume everything, whether it's food, whether it's, you know, also water, whether it's all sorts of different things, will be critical to everybody's the way that people live their lives. You know, it's such a fundamental thing, and it's the same with climate change, it's the same with biodiversity loss. But we will have to get to grips with those scenarios across every sector, and it's a social change as much as it is an environmental change.
Thanks, Alice. And perhaps, Chris, I'll come to you. The question I was going to ask you was, you know, the task force for nature-related financial disclosures, which Alice mentioned there, not confusing that with the one that everyone's using at the moment, which is the task force on climate-related disclosures. This is going to come into effect in sometime in the near future. I don't know exactly when, maybe you do. But these frameworks, can you talk about how they play out within your business? And specifically, given this is an investment trust seminar, could you talk about how that relates to environmental impacts, environmental trust, and really, I guess, sorry, this is multi-layered, but how all of that regulation sort of drives decision making over the next decade from a governance point.
Yeah. So firstly, let's so really quickly on. So we're very focused on this. We were early adopters at signing up to TCFD, and really have been pushing the importance of that framework getting mandatory backing. Great to see that being backed by the G7. It's on the agenda for the G20. Really looks like we're heading in the right direction there. And we're working with the Bank of England FCA Climate Financial Risk Forum to try to kind of demystify and clean up and make it easier for people to report against those frameworks. We also, I sat on the informal working group that's been doing the development work for the TNFD. So in answer to your question around timing, so TNFD will launch this year in terms of the work of the task force, but it's then a 2-year program where they've got a number of issues to look at. I'll come back to some of the complexities, but that will then produce an equivalent to the TCFD recommendations that came out in 2017. So that will be coming out in around, say, 2023. So we're around probably about 6 years away from that coming into regulation, because that's if you follow the TCFD framework. So why is this important? So the first thing is, how do we use it? I mean, the first thing is that you have to think about 2 dimensions of risk. In relation to climate, at least, and I think the same will go for nature and biodiversity. The firstly is the impact of the climate and our response to it on a firm, and the second one is the impact of the firm and, you know, society as a whole on the climate. So if you think about that first one, there are 2 impacts that TCFD encourages you to look at. The first is your exposure to physical climate risks and what's going to happen to you. So we've really pushed impacts. We've done a lot of work on that. We've done a lot of work on talking to the the companies we invest in. We've just done a review of S&P 500 in the US and their preparedness. And quite frankly, it's very, very low, the understanding of these issues. So having a proper understanding of physical climate risk, where your assets are, what they're exposed to, how do you get a heat map kind of approach to allow you to prioritize, and then kind of put the defenses in place and put the strategies in place to kind of reduce the potential losses, but also think about the opportunities. The second one is the transition risk. So really that comes from being the risk of stranded assets, because you have operations that are very carbon intensive, and perhaps there will be a policy change or a reputational change that will mean you have to go zero carbon in a rush, rather than gradually adjust your operations. And if you've got low margins and a potential of a high hit on a carbon price, that's where you get the report that came out this week that's saying you could wipe a $75 carbon price could wipe 20% off the valuation of the global stock markets. So those are the risks on the firm. Then thinking about the risks of or the impacts of the firm on the climate, that's when you get into the decarbonisation of your activities and investment in the solutions. And what we want to be doing is encouraging all firms to do that, so that we don't face, the worst case scenario when it comes to temperature rise and the tipping points that Tim's been talking about. So we incorporate all of that information into our investment practices by looking at potential carbon exposures, by trying to gauge where the physical risks are. And then what this becomes is just good investment practice. We are trying to understand how it affects the value of an organization, trying to understand what their plans are in terms of capital, and then we're making a decision about which companies to invest in based on just risk-adjusted returns. I think with PC, with nature, it's a bit different. And we know it's going to be different, but actually there's a lot we can learn from the progress that we've made on embedding this in to do with climate. But we have to be humble around the fact that this is just getting going. So we need to really are going to be, hopefully the TNFD will help us crunch through some of that. But actually the great thing is that some of the opportunities we do already know. So going back to Tim's point, when you actually start to look at, well, what are the sectors or the sectors that people are investing in with nature positive funds and things like that, you can reduce the drivers of biodiversity loss by doing other things that we already have in the impacts taxonomy. So you talked about the investment trust. We're already doing quite a lot of this. Pollution control, trying to address that, pushing the circular economy so that you reduce the demands on biodiversity and us wanting to take more out of nature. If we use existing resources better, that reduces that. And sustainable and smart farming, so things like vertical farming or digitization of farming, where you're using better use of AI in order to get more out of the area that's already being cultivated. But like I say, we've got to be humble and we've got to be innovative and we've got to be looking for these new solutions. I just hope the TNFD will put the spotlight on this, and people will then start to understand what the things are that are harming nature, so we create headwinds for those, and where the solutions lie, so that we can create a tailwind for investment into those.
Thanks, Chris. Yeah, I hope so too. I don't know if anyone else has got anything they want to add to that. If not, then we've got a few minutes for some questions. I've had some questions. So Alice, I'll come to you first. There's one of the audiences, and there might be more than one in the audience, but one of the audiences attending your course this summer, and would like to know what's your #1 book recommendation in advance of that course.
Oh,
obviously,
it's got to be Tim's book, hasn't it? It's got to be Tim's book, clearly. I think there's a lot of interesting stuff coming out. I mean, there's a lot of interesting stuff on impact. If one's looking to see different models and different ways of valuing externalities, then the book that Ronnie Cohen has written about impact is interesting, about impact weighted accounts, which sort of how we've all been trying to bring value into the sort of monetizing some of the values of climate change and biodiversity for a long time. One of the things that he's recommending in that book is how to do that. I don't know whether we've got the solution, but it's an interesting read. But no, I think in the background, if you want to read something about tipping points, just go for Tim's book.
And actually, Tim, there's a question for you. Do you think we need stronger regulation? And the question is there a conflict here? If the Arctic melts, there is financial benefits to that for governments, that in terms of oil reserves and state-run oil companies. So,
yeah, on that latter point, we're already seeing that, aren't we? The Arctic melting being seen as an opportunity for some. Do we need stronger regulation. I mean, of course, you can imagine ways in which I'm not sure it's stronger, but shall we say better or different regulation could really move the dial on this more effectively. Part of it for me is about it's not just about some sovereign investment banks still funding new coal power plants. It's about some really government or governments supporting effectively subsidizing the old way of doing things that is on the way out anyway and is driving us to the climate tipping point. So we need some current, which you could also describe as regulations. Well, I feel in that case, I feel there are some existing regulations which are fundamentally the wrong ones and need to be, we need to move the regulation elsewhere. I have some views, much broader views on the merits or otherwise of some of the global agreement trade on tariffs and those type of regulations, but let's not go down that rabbit hole. But we well see examples where regulation in the forms like the common agricultural policy in Europe, it is a disaster for biodiversity and the climate. So yeah, if I was to talk about regulations we might need or that we don't have yet, well, we saw in the case of the UK the power of putting a price on carbon in power generation, because it's basically shut coal burning out of UK power generation since 2012. On a price on carbon in that sector on top of a rather low and fluctuating EU carbon price that just wasn't effective. So in a simple regulatory sense, we don't want the same carbon price everywhere, but we probably want a sensible minimum carbon price blanket across the world economy if we could magic one up. And then on top of that, we need regulators or governance to deploy an appropriate additional carbon price depending on how much you need to tip the change in different sectors, where obviously for, say, iron and steel production, you need a whole lot more carbon price in that sector than you needed in power generation. So that's a brute and simple kind of regulation that many of us would have been calling for. And the only subtlety I have there is that I'm fundamentally against what most mainstream economists would recommend the same price blanket everywhere, because they're in a paradigm of what they call allocative efficiency. And I hope I've made the case that that isn't the smartest way to create change, which is what we're trying to do, to create efficiency of transformative change. So yeah, just on the books, by the way, I've written a couple and I'd opt for the smaller and much cheaper one, Earth System Science, a very short introduction as an entry point to this kind of thinking.
Thanks, Tim. And Chris, I think this is obviously a question directed at you, but it's surprising that Impact's Environmental Trust is not bigger. Given that the exponential rise in assets under management of Impact's asset management, what's the reason for that?
Geez, well, that's probably one that I'd want to put to the investment team rather than myself. But I guess we have a range of strategies that we are running with. Some are more focused on individual sectors. We're continuing to kind of innovate and think about what the next thing will be. Most recent one we launched is a strategy that is looking at climate more broadly. So we're looking at investment into adaptation as well as into sort of mitigation solutions. And I think it's just, these markets are still growing, and there are still a finite number of kind of companies that one can invest in who are pure plays. And actually what you've got now are quite a lot of conglomerates or larger companies that are coming into the sector. And it can be quite difficult if you've got someone who's only doing 20% of its revenue is coming from green, for that to be classified as green. So the size of the universe of stocks that you have will vary according to the particular constraints of the particular strategies you're looking at. But I think it's growing across the piece, and hopefully there will. One of the things that some of these net zero asset owner alliances and other things are are trying to work with asset managers and others to increase the number of potential investment vehicles that are out there, look at blended capital and look at other things. So I think there will be more products coming to market over the years.
I'm sure, Chris. So I've just realised we've just gone over the hour. So I'm going to say, look, thanks very much to the audience for joining and participating, and thank you, Alice, thank you, Tim, thank you, Chris. It's been incredibly informative, very thought-provoking, and it's a real pleasure to be here and experience your expertise and your time on this. So thank you once again, and we're going to be back later this month with another seminar. So please watch this space.
Great.
Nice
Thank you,
afternoon,
Lucky.
Thank you.
Thanks, everyone.
Bye.
Thanks, Lucky and all.